Hey everyone, welcome back for another deep dive. And today we're tackling a topic that you guys specifically requested.
Oh, yeah.
Yeah, we're diving into Benjamin Graham's classic, The Intelligent Investor, and focusing on Chapter 7.
Nice.
Yeah, this one is all about strategies for the enterprising investor.
Oh, this is a good one. The Intelligent Investor is pretty much the go-to guide for value investing, but Chapter 7 is where things get really interesting.
Okay, how so?
Well, it's not just for folks who are, casually dabbling in the market. This chapter is for those who are ready to, roll up their sleeves and really treat investing as a business.
Oh, so it's like taking it to the next level.
Right, exactly. It's about being proactive, seeking out opportunities, and making informed decisions.
So it's less about just kind of like picking a few stocks and hoping for the best.
Exactly. It's about developing a strategy, doing your research, and understanding how to analyze a company. And it's fascinating. He actually starts off by talking about bonds,
Yeah.
which might seem a bit unexpected in a chapter about enterprising investing, right?
Yeah, I thought it'd be straight into stocks.
Right. But Graham wants us to consider all our options, and he even suggests looking beyond the typical corporate or government bonds.
So, like, what kind of bonds is he talking about?
Well, he mentions some specific types that aren't really issued anymore, like new housing authority bonds or new community
Oh,
bonds.
okay.
But the takeaway is to think outside the box. He even talks about tax-free industrial bonds, which are kind of a unique beast.
Wow, so?
Well, they're issued by municipalities, but they're actually backed by strong corporations.
Oh, interesting.
Yeah, so they can offer some potential tax advantages, but you'd have to, dig into the specifics to see if they make sense for your situation.
Right. Always got to do your homework.
Absolutely. And then he throws in this other curveball, talking about special situations involving distressed or defaulted bonds.
Okay, now those sound a little risky.
Yeah, they can be. It's where the lines between bonds and stocks start to get kind of blurry.
How so?
Well, it's all about understanding that a bond isn't always just a safe, predictable investment.
Right.
There can be opportunities there for those who are willing to take on a bit more risk.
And who understand those really complex situations.
Exactly. It's all about understanding the intricacies of those unique situations.
So, okay, that's bonds, but I think a lot of people are probably really curious about what Graham has to say about stocks.
Well, for sure. And he does get into that, outlining 4 main activities for enterprising investors in the stock market.
Okay, lay them on me.
Okay, so we've got market timing, investing in growth stocks, buying bargain issues, and then capitalizing on those special situations we touched on earlier.
Okay, so let's break those down one by one, starting with market timing.
Sounds good.
I think everyone's heard the saying, buy low, sell high, but is it really that easy?
Oh, if only it were that simple. Graham himself, he was pretty skeptical about trying to time the market perfectly,
Yeah, that makes sense.
especially using mathematical formulas or relying on, short-term trends. He even suggests in another chapter for more conservative investors, he calls them defensive investors.
Oh.
He recommends what he calls the 50-50 plan.
Oh, I've heard of that, yeah.
Yeah, it's basically maintaining a balance between stocks and bonds, regardless of what's happening in the market at any given moment.
So it's like not trying to constantly guess when the market's going to go up or down.
Exactly. Yeah, just maintain that balance and ride it out. Take the emotion out of it.
Right. Ride the waves. Don't try to predict them.
Exactly. And, even Graham, with his brilliant analytical mind, he recognized that it's really tough to time the market perfectly, especially based on short-term patterns.
Yeah, because like even the experts can't always get it right.
Right. And what's interesting is that he brings this up in the chapter about being an enterprising investor, which suggests that maybe there are smarter ways to try to get those above-average returns.
So market timing, probably not the best strategy.
Yeah. It's tricky, for sure.
Okay, so what about growth stocks? Those are always a hot topic.
Oh, yeah, growth stocks. They're tempting, right? All that potential for rapid growth.
Yeah, everyone wants to get in on the next big thing.
Exactly. But Graham has some really crucial insights about growth stocks that we need to unpack.
Okay, I'm all ears. What do we need to watch out for?
Well, the main thing is to avoid overpaying for that future growth.
Okay.
The price of a growth stock usually already reflects those high expectations from the market.
Right.
So there's not much room for error if the company doesn't meet those expectations, right?
Makes sense.
And then there's always that risk that the growth could slow down or, even reverse.
So it's not just about picking companies that sound promising. It's about understanding how much you're paying for that potential.
Absolutely. It's about value, not just hype.
So is there any way to tell if a growth stock is, like, overpriced?
Well, Graham cautions against investing in companies with a price-to-earnings ratio above 20. And the thinking there is that if the price is that high compared to its current earnings, it means that the market is already assuming or pricing in a lot of future growth, which might not even happen.
Right, so it's like they're betting on the future, not on the present.
Exactly. Let me give you an example.
Okay.
Imagine a company, they earned $3 per share this past year, but their average earnings over the 6 years before that were only 50 cents a share.
Okay, big difference.
Huge, right. So if you're only looking at that $3, you might think, oh, this is a great deal, but
But you have to look at the bigger picture.
right, you got to zoom out. Because if you look at the average over the past 7 years,
Yeah.
it's a totally different story.
So you're saying it's not just about the most recent performance, it's about looking at the long-term track record.
Right, and this applies to funds too, not just individual companies.
Oh, okay, how so?
Well, Graham, he analyzed the performance of those growth funds, those mutual funds that focus specifically on picking growth stocks. And he found that over a 10-year period, their returns weren't that much better than the overall market.
Really?
Yeah. It challenges the idea that you can just pick a few growth stocks or a growth fund and easily beat the market.
That's surprising.
Right. It shows that even the professionals, with all their resources and expertise, they struggle to consistently beat the market just by focusing on growth.
So there's more to it than that.
Definitely.
Yeah.
And then Graham points out another risk with growth stocks. Even established companies, ones with a good history of growth, their stock prices can still fluctuate wildly
Because of...
because of market sentiment, basically.
Oh, so like even if the company's doing well, the stock price could drop because of like overall market trends or, investor psychology and stuff.
Exactly. He uses General Electric and IBM as examples. These are solid companies,
Yeah.
but their stock prices haven't always reflected that steady growth.
It's a good reminder that even if you believe in a company, you have to be prepared for those ups and downs.
Yeah, and for a lot of investors, that's the hardest part. When your portfolio is dropping, even if you think it's temporary, it takes a lot of discipline to hold on.
It's that emotional side of investing again.
Right. It's that battle between logic and emotion. We always hear those stories about the people who got rich by holding on to great companies for years and years.
Yeah, like buy and hold forever.
Exactly. But Graham points out that those early investors often had a different kind of connection to the company. Maybe they were employees or family members.
So they had more information and maybe more belief in the company than the average investor.
Exactly. They weren't just looking at the stock price. They were part of the company's journey,
So they had more at stake and maybe a longer-term perspective.
Exactly. So while those success stories are inspiring,
Yeah.
it's important to be realistic about the challenges that most investors face,
We don't all have that insider knowledge or that ability to stay calm when the market is going crazy.
Right, exactly. So if chasing those hot growth stocks isn't always the answer, what does Graham recommend for enterprising investors?
Yeah, that's the big question. What are the alternatives?
Well, he has three main suggestions. First, he suggests investing in unpopular large companies.
Unpopular. Wait, so you're saying intentionally look for companies that are out of favor?
Yeah, it sounds counterintuitive, right? But Graham observed this fundamental law of the market, he calls it.
Okay.
He noticed that the market tends to overvalue those really popular companies we were just talking about.
Right, the ones everyone's excited about.
Exactly. And it undervalues the companies that are temporarily out of favor. And he specifically suggests looking at large companies because they have the resources to, bounce back.
So it's about finding value where others are afraid to look?
Exactly. It's about being contrarian, thinking for yourself.
I like that. But does it actually work? I mean, is there any evidence that investing in unpopular companies can actually lead to profits?
Well, Graham points to a study by Drexel and Company. They looked at what would happen if you invested in the cheapest stocks in the Dow Jones Industrial Average every year.
Cheapest meaning?
Meaning the ones with the lowest price-to-earnings ratios. And they found that over a period of several decades, this strategy consistently beat the market.
Wow, that's a pretty compelling argument.
Right. It shows that there's real merit to this idea of looking for value in unexpected places.
But if it's that simple, why isn't everyone doing it?
Well, it's not quite as simple as just buying the cheapest stocks blindly, right?
Right.
Graham points out that even this approach isn't perfect.
So there are no guarantees in the market.
Right. And he says it's important to combine the quantitative analysis, like those price to earnings ratios, with your own qualitative judgment.
Oh, so you can't just rely on the numbers.
Exactly. You have to understand the company, its industry, and its overall prospects, too.
It's about seeing the whole picture.
Exactly. So that's one avenue, unpopular large companies. His second suggestion is to look for what he calls bargain issues. And this is where things get really interesting, I think.
Okay, bargain issues. Tell me more.
So he defines a bargain issue as a stock that's worth at least 50% more than its current market price.
Whoa, 50% more. So it's like finding a hidden treasure that the market is just completely overlooking.
Exactly. It's like finding a dollar bill on the sidewalk. It's there, but no one else seems to see it.
Okay, so how do you actually find these bargain issues? What's the secret?
Well, there's no magic formula, but Graham outlines two main tests.
Lay 'em on me.
First, there's the appraisal method, which involves estimating a company's future earnings,
Okay.
and then applying a multiplier to that number based on factors like its industry, growth potential, things like that.
So you're basically trying to figure out what the company is really worth based on its future potential and then comparing that to what the market is currently pricing it at.
Exactly. You're looking for that gap between the intrinsic value and the market price.
Okay, makes sense. And what's the second test?
The second test is to consider what Graham calls the private owner value.
Okay, what's that?
It's about looking at the company's assets and future earnings and asking yourself, what would someone be willing to pay for this company if it were being sold outright? Not just what the stock is trading for in the market.
So you're looking for companies that are basically worth more than the market is giving them credit for, whether that's based on their future earnings or their underlying assets.
Exactly. You're looking for the situations where the market is undervaluing a company's true worth.
Okay, so the big question is, how do these bargain opportunities even arise in the first place? Why doesn't the market always accurately reflect a company's value?
That's where things get really interesting. That's where market psychology comes into play. You see, Graham explains that market downturns often create widespread bargain opportunities.
So when everyone's panicking and selling, that's when the real bargains emerge.
Exactly. He uses General Motors in 1941 as an example. It was a solid company,
Yeah.
but its stock price plummeted during a market downturn, creating a great buying opportunity for those who could see past the fear.
Right. But it's easy to see those bargains in hindsight. The real challenge is identifying them in real time when everyone else is freaking out.
Oh, absolutely.
Yeah.
That's the million-dollar question. How do you separate the truly undervalued companies from those that are just temporarily out of favor? How do you avoid making a mistake and buying a stock that's actually on its way down?
Right, that's the key.
Exactly. And Graham highlights a few things to watch out for. First, he looks for companies with a stable earnings history.
Okay, so you're not just looking at the most recent quarter, you're looking at the long-term track record.
Exactly. If a company's earnings have been consistently strong, it's a good sign that it has a solid foundation.
So it's more likely to bounce back from a temporary setback.
Right. And he also emphasizes the importance of size and financial strength. Larger companies with strong financials tend to be more resilient.
They can weather those storms better.
Exactly. And he cautions against getting caught up in those volatile stocks that have those big price swings.
Oh yeah, those can be tempting, but also risky.
Right, exactly. He uses Chrysler as an example, pointing out that while its volatility might make for great hindsight investments, in real time, it would have been a very risky bet.
So it's about finding that balance between potential rewards and potential risks.
Exactly. You want companies that are undervalued, yes, but also strong enough to survive those tough times.
Okay, so are there any examples of bargain issues that came about simply because the market overlooked a company's true value?
Oh yeah, Graham gives a couple of really interesting examples. One is National Presto Industries in 1970.
Okay.
It was trading below its net current asset value,
Meaning?
meaning you could have bought it for less than the value of its liquid assets.
Whoa. So you're basically getting the rest of the company for free?
Pretty much. And this was despite the fact that its earnings had been increasing.
It's like finding a $20 bill on the ground and no one else sees it.
Exactly. Sometimes value is hidden in plain sight. Another example he gives is Standard Oil of California in 1972.
Okay.
This was a company with incredibly steady earnings.
So a safe bet, you might say?
You'd think so, right? But it was selling at a price-to-earnings ratio well below its historical average.
So the market just wasn't giving it the credit it deserved?
Exactly. Sometimes you have to dig a little deeper and not just rely on the market's current assessment of a company.
Right, so don't just follow the herd, do your own research.
Absolutely. And Graham also talks about situations where the market might misinterpret a company's earnings.
Okay, how so?
He gives the example of Northern Pacific Railway in the late 1940s. Its price was suppressed because it had a low dividend, even though its earnings were actually really strong.
Oh, so investors were focusing on one number, the dividend, and missing the bigger picture.
Exactly. They were missing the forest for the trees. It's a good reminder that you have to look beyond the obvious metrics sometimes and really understand the company's financials.
Dig deeper, understand the nuances.
Exactly. Now, he also introduces this really fascinating concept called sub-working capital stocks.
Sub-working capital, that sounds complicated.
It's actually pretty straightforward. These are companies that are selling for less than their net working capital, after you subtract all their obligations, of course.
So you're saying you could buy a company for less than the value of its liquid assets.
That's the basic idea. And all of its fixed assets, its factories, equipment, all that, you're essentially getting those for free.
That's wild. So it's like buying a dollar for 50 cents.
Exactly. And Graham found that a portfolio of these stocks did really well, way better than the overall market.
So it's like a secret formula for success.
Well, not quite a secret anymore, and he does point out that these opportunities have become less common as the market has risen over the years.
So the secret's out.
Pretty much. But he does hint that we'll explore this concept further in Chapter 15.
Oh, so there's more to come.
Definitely. And he also briefly touches on bargain bonds and preferred stocks, saying they were once plentiful when interest rates were low, but now they require more specialized knowledge.
Okay, so we might need to do a whole deep dive on those someday.
Sounds like a plan. Now, before I move on, I'm curious, how do you think this idea of bargain issues applies to those secondary companies we talked about earlier?
Good question. First, remind me, how does Graham define a secondary company?
He defines them as those companies that aren't the industry leaders.
Okay.
They might be smaller companies, or they might be in industries that aren't as, in the spotlight.
Right, right. So they're kind of like the underdogs of the market.
Exactly. And he observed that the market tends to undervalue these companies even when they have solid fundamentals.
Why is that? Are they seen as riskier or less likely to succeed?
It's more about perception than reality, really. After the Great Depression, investors developed a strong preference for those industry leaders, the big names.
Oh, so it's like a safety in numbers kind of thing.
Exactly,
Sure.
yeah. And this kind of created a pattern where secondary companies were consistently trading at lower prices relative to their earnings and assets.
So it's another example of the market overreacting and creating opportunities for those who can see past the headlines.
Exactly. But if secondary companies are so often undervalued, why don't they just stay that way forever?
Yeah, that's a good question. How can investors actually profit from this? What makes the market eventually recognize their true value?
Well, Graham suggests a few ways. First, because their prices are lower, secondary companies often have higher dividend yields.
Oh, so you're getting a bigger payout relative to the price you paid for the stock.
Exactly. You're getting more bang for your buck, so to speak. And then their reinvested earnings become more substantial compared to their price.
So it's like they're growing from within, even if the market isn't fully recognizing it yet.
Precisely. And then when the overall market is in a bull market, those low-priced stocks tend to benefit even more.
Oh, interesting. So they rise at a faster rate than the more expensive stocks.
Often, yeah. And lastly, there's this constant process of price adjustment happening in the market. Even if a secondary company is undervalued for a while, eventually the market tends to catch up and its price moves closer to its true worth.
So it's a combination of factors: higher dividends, reinvested earnings, the overall market trend, and the market's tendency to eventually correct itself.
Exactly. It's like a perfect storm of value creation. But he also points out another interesting dynamic that's emerged in recent decades:
What's that?
acquisitions. Big companies are increasingly buying up smaller companies.
Oh, yeah, that's been happening a lot lately.
Right. And they often pay a premium for those acquisitions.
So you might not even have to wait for the market to recognize a secondary company's value. It could get bought out by a bigger company at a much higher price.
Exactly. It creates a whole new layer of opportunity for investors who can spot those undervalued targets.
So there's a lot to consider when it comes to secondary companies, especially those bargain issues.
Oh, definitely. But I think it's important to remember that there are risks involved, too.
Of course, there's always risk in the market.
Right. But Graham points out that investing in secondary companies, especially those bargain issues, requires careful analysis and a willingness to, go against the grain.
So it's not for the faint of heart.
Definitely not. You have to be confident in your judgment and patient enough to let the market catch up to your assessment.
So it's about thinking for yourself, doing your homework, and being willing to wait for the payoff.
Exactly. And that brings us to the third avenue for enterprising investing that Graham outlines: special situations. And this is where things get even more, let's say, adventurous.
Okay, I'm intrigued. What are special situations and why are they so adventurous?
Well, he's talking about those investment opportunities that arise from specific corporate events.
Like what?
Think mergers, acquisitions, reorganizations, spin-offs, even bankruptcies.
Whoa, okay. Those do sound pretty special.
Right, and these situations often create price discrepancies because the market might not fully understand the complexities.
Because they're unique situations.
Exactly. Or sometimes investors have these biases or preconceived notions that might not reflect reality.
So it's like a hidden market within the market.
Exactly. But it takes a certain level of expertise to navigate these special situations.
I can imagine. It's not just about analyzing a company's financials. It's about understanding those complex legal and financial maneuvers.
Exactly. You need to be able to see the bigger picture and anticipate how these events might play out.
It's like being a detective, piecing together clues.
That's a great analogy. And Graham provides some historical examples of how investors have profited from special situations.
Oh, I'd love to hear about those. What are some of those success stories?
Well, he talks about how some savvy investors made a lot of money by buying the bonds of those bankrupt railroads.
Okay.
They knew that those bonds would be worth a lot more after the railroads were reorganized.
So it's about anticipating how those corporate events might play out
Yeah.
and taking advantage of the market's mispricing.
Exactly. And he also mentions the breakup of those public utility holding companies back in the 1930s.
Right, that was a big deal.
It was. And it created a lot of value for investors who understood how to navigate that complex situation. And he highlights a more recent trend that we already talked about a little bit, the way those big companies are buying up smaller ones.
Acquisitions are happening all the time these days.
Exactly. And he sees this as a continuing trend that offers potential for investors who can identify those undervalued targets.
So it's about being ahead of the curve, seeing those opportunities before everyone else does.
Exactly. But he does acknowledge that this is an area that requires, specialized knowledge and experience.
It's not for everyone.
Definitely not for everyone. But he points out that there's often a lot of fear and uncertainty surrounding these special situations, which actually creates those bargain opportunities.
Oh, because other investors are too scared to get involved.
Exactly. He even quotes that old Wall Street saying, "Never buy into a lawsuit." It's a reminder that there's risk involved, but that risk can also create opportunity.
So for those who are willing to do their homework and take on that risk, special situations can be a very rewarding area of investing.
Absolutely. And that brings us back to the central theme of the chapter, the importance of choosing your investor role and sticking to it.
Right, defensive or enterprising.
Exactly. And if you choose to be an enterprising investor, Graham emphasizes that it doesn't mean being reckless. It means treating investing like a business.
So you need to have a clear strategy, do your research, and make informed decisions.
Exactly. You can't just fly by the seat of your pants. You need a plan.
Now, before we move on, I'm curious about something you mentioned earlier, the paradox of secondary companies. You said that well-chosen secondary companies can be just as promising as industry leaders because of their potential for growth, but historically, investors have done better buying them at bargain prices, not at their full enterprise value.
Right, right.
So how do we make sense of that? Why wouldn't investors be willing to pay full price for a company that has great growth potential?
That's the paradox, isn't it? And it goes back to something we've been talking about throughout this whole discussion: market psychology.
The market doesn't always behave rationally.
Exactly. Emotions and biases often get in the way of sound judgment. And when it comes to secondary companies, this mispricing can be even more pronounced.
Because,
Well, investors tend to flock to the familiar names, the industry giants, even if those companies have already realized most of their growth potential.
so they're paying a premium for familiarity.
Right. And meanwhile, those smaller, less-known companies, even the ones with exciting prospects, they often get overlooked or undervalued.
So it's like there's a discount applied to the unknown.
Exactly. And that's where the opportunity lies for enterprising investors.
Because if you can identify those undervalued companies with growth potential,
You can buy them at a discount and potentially reap the rewards as they grow, and the market eventually catches up.
it's like finding those hidden gems before everyone else does.
Precisely. But, as we've been saying, it takes a certain mindset. You have to be willing to go against the grain, to trust your own judgment, and to be patient.
Because those undervalued companies might not stay undervalued forever.
Right. And Graham offers some insights into why these companies often see their valuations rise over time.
Oh, I'm all ears. What are some of those factors that can drive up the price of an undervalued secondary company?
Well, first, as we discussed, they often have higher dividend yields because their prices are lower.
Right, more bang for your buck.
Exactly. And those reinvested earnings, they can really compound over time and boost the company's value.
So it's like a snowball effect.
Right. And then when the market is in a bull market, those lower price stocks often rise at a faster rate than the more expensive ones, amplifying your gains.
So you're riding the wave, but in a smaller, more nimble boat.
Exactly. And finally, there's that constant process of price adjustment happening in the market, you know? Eventually, even if it takes time, the market tends to recognize a company's true worth.
So it's a combination of factors that can work in your favor if you're patient and have chosen wisely.
Exactly. But he also points out another interesting dynamic that has emerged in recent decades:
Okay, what's that?
acquisitions. You know, big companies are increasingly buying up smaller companies, and they often pay a premium for those acquisitions.
So you might not even have to wait for the market to recognize a secondary company's value. It could just get bought out by a bigger company at a much higher price.
Exactly. It creates a whole new layer of opportunity for investors who can spot those undervalued targets.
So there's a lot to consider when it comes to secondary companies, especially those bargain issues.
Oh, definitely. But I think it's important to remember that there are risks involved, too.
Of course, there's always risk in the market.
Right. But Graham points out that investing in secondary companies, especially those bargain issues, requires careful analysis and a willingness to, go against the grain.
So it's not for the faint of heart.
Definitely not. You have to be confident in your judgment and patient enough to let the market catch up to your assessment.
So it's about thinking for yourself, doing your homework, and being willing to wait for the payoff.
Exactly. And that brings us to the third avenue for enterprising investing that Graham outlines: special situations. And this is where things get even more, let's say, adventurous.
Okay, I'm intrigued. What are special situations and why are they so adventurous?
Well, he's talking about those investment opportunities that arise from specific corporate events.
Like what?
Think mergers, acquisitions, reorganizations, spin-offs, even bankruptcies.
Oh, okay. Those do sound pretty special.
Right, and these situations often create price discrepancies because the market might not fully understand the complexities.
Because they're unique situations.
Exactly. Or sometimes investors have these biases or preconceived notions that might not reflect reality.
So it's like a hidden market within the market.
Exactly. But it takes a certain level of expertise to navigate these special situations.
I can imagine. It's not just about analyzing a company's financials. It's about understanding those complex legal and financial maneuvers.
Exactly. You need to be able to see the bigger picture and anticipate how these events might play out.
It's like being a detective, piecing together clues.
That's a great analogy. And Graham provides some historical examples of how investors have profited from special situations.
Oh, I'd love to hear about those. What are some of those success stories?
Well, he talks about how some savvy investors made a lot of money by buying the bonds of those bankrupt railroads.
Okay.
They knew that those bonds would be worth a lot more after the railroads were reorganized.
So it's about anticipating how those corporate events might play out
Yeah,
and taking advantage of the market's mispricing.
exactly. And he also mentions the breakup of those public utility holding companies back in the 1930s.
Right, that was a big deal.
It was. And it created a lot of value for investors who understood how to navigate that complex situation. And he highlights a more recent trend that we already talked about a little bit: the way those big companies are buying up smaller ones.
Acquisitions are happening all the time these days.
Exactly. And he sees this as a continuing trend that offers potential for investors who can identify those undervalued targets.
So it's about being ahead of the curve, seeing those opportunities before everyone else does.
Exactly. But he does acknowledge that this is an area that requires, specialized knowledge and experience.
It's not for everyone.
Definitely not for everyone. But he points out that there's often a lot of fear and uncertainty surrounding these special situations, which actually creates those bargain opportunities.
Oh, because other investors are too scared to get involved.
Exactly. He even quotes that old Wall Street saying, never buy into a lawsuit. It's a reminder that there's risk involved, but that risk can also create opportunity.
So for those who are willing to do their homework and take on that risk, special situations can be a very rewarding area of investing.
Absolutely. And that brings us back to the central theme of the chapter, the importance of choosing your investor role and sticking to it.
Right, defensive or enterprising.
Exactly. And if you choose to be an enterprising investor, Graham emphasizes that it doesn't mean being reckless. It means treating investing like a business.
So you need to have a clear strategy, do your research, and make informed decisions.
Exactly. You can't just fly by the seat of your pants, you know. You need a plan.
Now, before we move on, I'm curious about something you mentioned earlier, the paradox of secondary companies. You said that well-chosen secondary companies can be just as promising as industry leaders because of their potential for growth, but historically, investors have done better buying them at bargain prices, not at their full enterprise value.
Right, right.
So how do we make sense of that? Why wouldn't investors be willing to pay full price for a company that has great growth potential?
That's the paradox, isn't it? And it goes back to something we've been talking about throughout this whole discussion, market psychology.
The market doesn't always behave rationally.
Exactly. Emotions and biases often get in the way of sound judgment. And when it comes to secondary companies, this mispricing can be even more pronounced.
Because,
Well, investors tend to flock to the familiar names, the industry giants, even if those companies have already realized most of their growth potential.
so they're paying a premium for familiarity.
Right. And meanwhile, those smaller, less-known companies, even the ones with exciting prospects, they often get overlooked or undervalued.
So it's like there's a discount applied to the unknown.
Exactly. And that's where the opportunity lies for enterprising investors.
Because if you can identify those undervalued companies with growth potential,
You can buy them at a discount and potentially reap the rewards as they grow, and the market eventually catches up.
it's like finding those hidden gems before everyone else does.
Precisely. But, as we've been saying, it takes a certain mindset. You have to be willing to go against the grain, to trust your own judgment, and to be patient.
Because those undervalued companies might not stay undervalued forever.
Right. And Graham offers some insights into why these companies often see their valuations rise over time.
Oh, I'm all ears. What are some of those factors that can drive up the price of an undervalued secondary company?
Well, first, as we discussed, they often have higher dividend yields because their prices are lower.
Right, more bang for your buck.
Exactly. And those reinvested earnings, they can really compound over time and boost the company's value.
So it's like a snowball effect.
Right. And then when the market is in a bull market, those lower price stocks often rise at a faster rate than the more expensive ones, amplifying your gains.
So you're riding the wave, but in a smaller, more nimble boat.
Exactly. And finally, there's that constant process of price adjustment happening in the market, you know? Eventually, even if it takes time, the market tends to recognize a company's true worth.
So it's a combination of factors that can work in your favor if you're patient and have chosen wisely.
Exactly. But he also brings up this idea that when it comes to secondary companies, there's this paradox.
Oh, how so?
He's saying, well-selected secondary companies, they can be just as promising as those big industry leaders,
Okay.
right? Because of their potential for growth and all. But then he says historically, investors have actually done better buying them at those bargain prices
Oh, interesting.
instead of their full enterprise value, meaning what the company would be worth if it was, being sold outright.
So, like, why wouldn't investors be willing to pay full price for a company that has all this growth potential?
Well, that's the thing, right? The market doesn't always act rationally.
Yeah.
It's like we've been saying, right? It's that market behavior, not necessarily a reflection of the company itself.
So are you saying it's about recognizing that the market's perception of a company doesn't always match up with its true potential?
Exactly. And with these secondary companies, this mispricing can be even more obvious.
Okay, I'm following you.
Investors, they often go for those big names, the industry leaders, even if those companies, they've already grown a lot.
So, like, the thrill is gone, so to speak.
Right, like they're paying a premium for that familiarity.
That's interesting.
Right, and then those smaller companies, even the ones with great potential, they get overlooked.
It's like there's this built-in discount for being the underdog.
Exactly. And that's where the opportunity comes in, right? If
Yeah.
you, as an enterprising investor, if
Yeah.
you can find those undervalued companies, the ones with that growth potential,
Uh-huh.
you can get them at a discount and then potentially, profit as they grow.
It's all about finding those hidden gems.
Right. And that's the exciting part of being an enterprising investor, isn't it? You're
Yeah.
not just like passively riding the market. You're
Yeah.
actively searching for those opportunities.
You're playing offense, not defense.
Exactly. But it does take a certain mindset, right? You got to be willing to think differently, to trust your own judgment.
Be a little bit of a rebel.
Exactly. And Graham, he actually points out that when it comes to investing in these secondary companies,
Yeah.
there's a difference between being an insider and an outsider.
Okay, what's the difference?
So insiders, they have, some level of control over the company.
Yeah.
They're on the management team or they have a big ownership stake.
They're in the inner circle.
Right. And they have a different perspective, a different set of information than those of us on the outside.
So they're playing by a different set of rules.
Exactly. And for outsiders, like most of us,
Right.
we have to be even more careful, even more diligent in our research and analysis.
Because we don't have access to that inside information.
Right, exactly. We have to rely on what's publicly available, the financial statements, the company's track record, all that.
So we have to be extra sharp, extra discerning.
Exactly. We got to be like detectives piecing together the clues.
I like that analogy.
Right. And, this whole discussion about insiders and outsiders, it highlights this really important aspect of investing.
What's that?
It's not just about numbers, it's about people.
Oh, interesting. So you're saying you have to understand the people who are running the companies you're investing in.
Absolutely. Their motivations, their incentives, their track record, all of that.
So it's like doing a background check on the management team.
In a way, yeah. And Graham, he actually goes into some detail about this in the next section of the chapter.
Oh, really? What does he say about the importance of understanding the management team?
Well, he calls it shareholder management relations. And he basically argues that, when you buy stock in a company,
Yeah.
you're not just buying a piece of paper.
Right.
You're becoming a part owner of that business.
Right, a stakeholder.
Exactly. And as a part owner,
Yeah.
you have a right to expect that the management team is acting in your best interests.
So it's not just about analyzing the financials, it's also about evaluating the people who are making the decisions.
Precisely. And Graham suggests that investors pay close attention to how management communicates with shareholders, how they allocate capital, and how they make those big decisions that can affect the long-term health of the business.
So it's about being an engaged owner, not just a passive bystander.
Exactly. You're not just along for the ride, you have a voice, and you should use it. And this brings up another interesting point that Graham makes.
I'm all ears.
He says that sometimes the interests of shareholders and the interests of management might not be perfectly aligned.
Oh, there can be conflicts of interest.
Exactly. For example, management might be focused on short-term profits.
To boost their bonuses, maybe?
Right. While shareholders might be more interested in long-term growth and stability.
So you have to be aware of those potential conflicts and make sure that management is truly acting in the best interests of the shareholders.
Exactly. It's about being an informed and active owner holding management accountable.
It sounds like there's a lot more to investing than just picking stocks and hoping for the best.
Oh, absolutely. It's about understanding the businesses you're investing in, the people who are running those businesses, and the dynamics of the market itself.
It's about being a student of the game.
Exactly. And that's what makes Graham's book so valuable. He doesn't shy away from the complexity, he embraces it. And he gives you the tools to navigate that complexity and make informed decisions.
Well, I have to say I'm feeling much more confident about my own investment decisions after this deep dive into Chapter 7.
That's great to hear.
What are some of the key takeaways that you think our listeners should walk away with?
Well, I think the most important lesson is that becoming an intelligent investor is a journey.
It's not something you learn overnight.
Exactly. It's about continuous learning, adapting, and refining your approach as you gain experience.
It's about always being curious, asking questions, and challenging your assumptions.
Exactly. And it's about remembering that investing isn't just about picking stocks and bonds. It's about making decisions that'll help you achieve your financial goals and live the life you want to live.
So it's about connecting your investments to your values and your vision for the future.
Precisely. And that's where the real power of Graham's wisdom lies. He doesn't just give you a set of rules to follow.
Right.
He helps you become a more intelligent, more confident investor.
He empowers you to take control of your financial future.
Exactly. Now, before we wrap up,
Yeah.
I want to leave our listeners with one final thought.
Okay.
Imagine you had the chance to, sit down with Benjamin Graham himself,
Oh, wow.
right, and just pick his brain about investing in today's market with all its complexities and challenges. What questions would you ask him?
That's a great question to ponder. It really encourages us to keep learning and keep exploring.
Exactly, because that's what being an intelligent investor is all about. It's about never stopping asking questions, never stopping learning, and always striving to make smarter decisions.
Well said. And on that note, we'll wrap up this deep dive into Chapter 7 of The Intelligent Investor. Thanks for joining us, and we'll see you next time for another exciting exploration of the world of investing. So it really is about finding that balance between recognizing the potential of these companies and being realistic about the market's tendency to undervalue them.
Exactly, exactly. And it all comes back to, that fundamental question that Graham poses early on in the chapter.
Yeah.
Are you a defensive investor or are you an enterprising investor?
Right.
And there's no right or wrong answer, right?
No, it's about what's right for you.
Right, exactly. It's about figuring out, what fits your personality, your risk tolerance, how much time you want to spend managing your investments.
Right. It's all about finding that strategy that aligns with your own individual needs and goals.
Precisely. And, it's not like you're stuck in one category forever, right? Your situation can change, your goals can evolve, and your investing style might have to adapt along the way, too.
It's all about being flexible and adjusting to the circumstances.
Right, exactly. Life is dynamic, and so are our finances.
Well said. So as we wrap up this deep dive into Chapter 7,
Yeah.
are there any final nuggets of wisdom from Graham that we haven't touched on yet? Anything you think would be particularly helpful for our listeners as they, continue on their journey to becoming more intelligent investors?
Well, Graham ends the chapter with this really interesting discussion about shareholder management relations.
Okay.
And he makes this point that when you buy stock in a company, you're not just buying a piece of paper, you're becoming a part owner of that business.
Right. You're a stakeholder.
Exactly. And as a part owner, you have a right to expect that the management team is acting in your best interests.
So it's not just about analyzing the numbers, it's about understanding the people who are running the company.
Exactly. It's about understanding their motivations, their incentives, their track record.
So it's like you're not just evaluating the company, you're also evaluating the management team.
Precisely. And Graham, he actually suggests that investors pay attention to things like how management communicates with shareholders, how they allocate capital.
So you're saying be an engaged owner, not just a passive bystander.
Right. Ask questions, hold management accountable, make sure your voice is heard.
And that brings up another important point that Graham makes, right?
What's that?
That sometimes the interests of the shareholders and the interests of management might not be perfectly aligned.
Oh, that's a really important point. Sometimes there can be conflicts of interest.
Yeah, like maybe management is focused on short-term profits to boost their bonuses, but shareholders are more interested in long-term growth.
Exactly. So you have to be aware of those potential conflicts and make sure that management is really acting in the best interests of the shareholders over the long haul.
It's about being an informed and active owner.
Exactly. It's about taking ownership of your investments and making sure your voice is heard.
Well, I feel like we've covered a lot of ground today.
We have. This chapter is packed with insights.
It really is. I feel much more equipped to tackle my own investment decisions after this deep dive.
That's great to hear. That's what we like to hear.
So as we wrap up, what are some of the key takeaways you think our listeners should walk away with?
I'd say the most important thing to remember is that becoming an intelligent investor, it's a journey, not a destination.
Right, it's a process.
Exactly. It's about continuous learning.
Always be learning.
Right. Adapting, refining your approach as you go, gaining that experience.
So always be curious, ask questions, challenge those assumptions.
Exactly. And it's about remembering that investing is not just about, picking stocks and bonds. It's about making decisions that'll help you achieve your financial goals. Live the life you want to live.
It's about aligning your investments with your values, with your vision for the future.
Precisely. That's what makes it so powerful. It's not just about money, it's about life.
Well said.
Yeah.
And on that note, I think we'll wrap up this deep dive into Chapter 7 of The Intelligent Investor. Thanks for joining us, everyone. And we'll see you next time for another exciting exploration of the world of investing.